What if the real price of silver is not the number you see on your screen? What if the true signal is not coming from London or New York, but from the physical metal quietly moving across borders? What if the most important indicator in the entire silver market is not headlines, not opinions, not short-term volatility, but one simple thing: deliveries? Because when physical metal starts moving in size, when premiums refuse to disappear, and when arbitrage does not close the way it normally does, that is when you know something structural is happening beneath the surface. Welcome to Gold Silver Scope. Let's begin with something that should not exist in today's high-speed, algorithm-driven markets. A $10 premium between Western silver prices and prices in Shanghai should vanish almost instantly. In theory, capital moves at lightning speed. If there is a pricing gap, traders flood the market, ship metal, close the spread, and balance is restored. That is how arbitrage works. It is mechanical, it is ruthless, it is fast. But this time, it is not closing. For months, silver has continued flowing east, while Chinese buyers are paying roughly $10 above Western pricing. And here is the key detail most people misunderstand. That premium is not offset by VAT in the way many assume. The VAT is paid by the recipient when the metal is withdrawn from the Shanghai exchange. It is not absorbed by the sender. That means the buyer is willingly paying the premium plus the tax on top of it. That is not normal market behavior driven by short-term profit. That is behavior driven by strategic necessity. Think about what that implies. If you are paying a $10 premium and additional tax just to secure physical silver, you are not thinking about flipping it tomorrow. You are thinking long-term. You are thinking supply security. You are thinking about ownership of something tangible in a world where paper assets are expanding endlessly. This is happening while China is the second largest silver producer in the world and one of the most dominant refiners of d'or bars globally. D'or bars are the crude silver and gold bars that miners pull from the ground before final refining. A large portion of global d'or flows into China for refining. Historically, much of that refined metal would then flow back into Western markets. But policy signals have changed. In November, Chinese authorities made it clear that domestically mined silver would be retained for domestic use. Later, export restrictions focused on refined metal added further tightening to global supply. This was not random. It followed the United States classifying silver as a critical mineral. When a commodity becomes strategically important, supply chains become political. Now combine that with the premium behavior. China is holding its own mined supply, limiting refined exports, and still paying above Western prices for additional silver. That is not a temporary dislocation. That looks like preparation. At the same time, China holds massive reserves of US dollars due to its long-standing trade surplus. But policymakers understand currency risk. Fiat currency purchasing power can erode. When you hold trillions in foreign reserves, you must ask a simple question. What is the safest way to preserve value? One answer is physical commodities. Not paper contracts, not leveraged derivatives, physical metal. This mentality is not new. For years, analysts argued that Chinese gold mining was uneconomical at certain price levels. It did not matter. Production continued. Costs were secondary to accumulation. The objective was not quarterly profit. The objective was long-term ownership. We are seeing a similar mindset in silver. And this is where the most important signal comes in. Deliveries. When metal is consistently withdrawn from exchanges, when forward markets begin to show stress, when physical becomes harder to source, that is when you pay attention. Futures prices can be influenced by leverage, speculation, and short positioning, but deliveries cannot be faked. Either the metal leaves the vault or it does not. If arbitrage remains open for months, if physical continues to flow east, and if premiums hold despite taxes and costs, then the logical conclusion is simple. The buyers do not believe the Western paper price reflects reality. They are using that paper price as an opportunity. And in modern markets, sustained arbitrage is not an accident. It is a signal. This may be the early stage of price discovery shifting away from purely leveraged derivative markets toward exchanges where physical settlement matters more. If that transition accelerates, the repricing will not be gradual. It will be fast, because once speculation unwinds and only real supply and demand remain, the market resets to where physical buyers and sellers agree, not where paper contracts suggest. And that is why deliveries matter more than noise. Now let's go deeper into the mindset behind this strategy, because this is where most people fall short when analyzing the silver market. Many investors today think in short cycles. They think in weeks, maybe months. They look at charts, momentum, quick gains. But the behavior we are watching in the physical silver market is not short-term thinking. It is generational thinking. We grew up in a system where hard work, patience, and long-term positioning mattered. Today's financial culture has been shaped by instant gratification, high-leverage trades, crypto spikes, AI stock surges, fast money. But sovereign strategy does not operate like that. Nations think in decades, not quarters. When a country systematically retains its domestically mined silver, limits refined exports, pays a premium for additional imports, and absorbs taxes without hesitation, that is not speculation. That is accumulation. And this fits into a much bigger pattern. Look at the last 20 years of global infrastructure development tied to China's expansion strategy. Through initiatives like the Belt and Road Initiative, China has built deep relationships with resource-rich nations across Asia, Africa, and parts of Europe. These are countries rich in minerals, energy resources, and strategic shipping routes. At the same time, economic alliances like BRICS have brought together nations that collectively control enormous commodity reserves. This is not random diplomacy. It is supply chain positioning. Now think about silver specifically. Silver is not just a monetary metal. It is critical for solar panels, electronics, electric vehicles, defense systems, and advanced technology manufacturing. In a world transitioning toward electrification and renewable energy, silver demand has structural strength. If you want industrial resilience, you secure silver. At the same time, China already dominates rare earth processing globally. Around 90% of rare earth refining capacity is tied to Eurasian supply chains, with China controlling the majority of processing. When the previous U.S. administration under Donald Trump announced plans for a multi-billion-dollar smelter in partnership with a South Korean firm, it was recognition of this imbalance. Western governments understand that refining capacity equals leverage. The same logic applies to silver. If you control refining, if you control domestic supply, and if you are steadily accumulating imports at a premium, you are strengthening your position in future price discovery. And here is the key. The arbitrage gap between Western prices and Shanghai prices should not persist in a fully efficient system. In today's algorithm-driven markets, a $10 spread should disappear quickly. Major trading desks, hedge funds, and bullion banks would normally exploit that difference until it collapses. They would ship metal, close the spread, collect profit, and restore equilibrium. But the spread has remained. That suggests something very important. Either Western sellers are willing to keep sending metal east because they trust paper pricing more than physical demand, or Eastern buyers are deliberately absorbing everything available regardless of short-term cost. The longer this continues, the more it challenges the credibility of Western paper pricing mechanisms. If futures markets in London and New York truly reflected physical scarcity, sustained arbitrage would not survive for months. Price discovery would adjust upward until the incentive to export vanished. But instead, metal continues to leave. That tells us the paper market may be disconnected from physical reality. We are also seeing signs of tightness in forward contracts. When market makers struggle to source metal for delivery, hedging becomes more difficult. Liquidity starts to thin. Exit doors become narrow. This is how structural shifts begin, quietly, gradually, then suddenly. Another important factor is currency dynamics. China's enormous trade surplus has left it holding vast quantities of US dollars. But policymakers understand a simple truth. Fiat currencies lose purchasing power over time. If you are holding large reserves, converting paper claims into tangible assets becomes logical risk management. Paying a premium above Western silver prices might look irrational from a trader's perspective. But from a sovereign wealth preservation perspective, it makes sense. If you believe the Western price is artificially suppressed by leveraged derivatives, then buying physical at a premium is simply buying at the real market value. This is the same pattern seen in gold accumulation over decades. Officially reported reserves often lag behind real acquisitions. Purchases can be distributed across state entities, ministries, and sovereign structures. Reporting to international bodies like the IMF is largely voluntary. Not all accumulation is transparent. So, when analysts try to calculate exact holdings based only on official data, they may be underestimating reality. Now combine that with silver's dual role as both monetary hedge and industrial necessity. The long game becomes clear. Gradually drain the system. Use Western paper pricing to your advantage. Accumulate physical metal while others focus on speculative trades. And as long as Western participants continue selling at paper prices disconnected from Eastern physical demand, the flow will continue. Price discovery may not shift overnight. But the longer this arbitrage holds, the more likely it becomes that the center of gravity for silver pricing moves eastward. Because in the end, real price is determined where real metal changes hands, not where leverage multiplies contracts. And that is why this is not noise, it is structure. Now we come to the most important question. What happens if this continues? If physical silver keeps moving from west to east, if premiums in Shanghai remain firm, if domestic supply is held back while imports are absorbed at higher prices, then we are not looking at a temporary imbalance. We are potentially watching the early stages of a structural reset in global silver pricing. And the biggest clue is still deliveries. Every month, billions of dollars worth of metal is standing for delivery on major exchanges. Very few people ask who is taking that metal. Who has the capital to absorb that volume consistently? Retail investors cannot do that. Small hedge funds cannot do that. This is deep capital, institutional capital, potentially sovereign-level capital. We see similar patterns on both sides of the world. Exchanges are not purely free market playgrounds. They operate under state regulation, and in strategic commodities, state influence is never zero. In China, multiple ministries and state-linked entities historically accumulate gold and other strategic assets beyond what is officially reported. Reporting to international institutions is largely voluntary. Not all purchases are immediately visible. The same logic can apply to silver. If sovereign-level players are accumulating through proxies, commercial banks, or state-linked funds, then what looks like normal market activity may actually be strategic positioning. That matters because sovereign capital does not trade emotionally. It does not panic sell. It does not chase headlines. It accumulates patiently. Now look at the broader commodity picture. Rare earth dominance, control of refining capacity, infrastructure expansion through the Belt and Road Framework, resource alliances through BRICS, domestic retention of mine supply, premium payments for imported physical metal, tightness appearing in forward contracts. Individually, each of these signals could be dismissed. Together, they form a pattern. And here is the uncomfortable reality for Western markets. As long as paper contracts set price while physical flows elsewhere, the system becomes vulnerable. If at some point Western sellers decide they are no longer willing to ship metal at suppressed prices, or if exchange inventories tighten to a critical level, repricing will not be gradual. It will be violent. Arbitrage that normally closes in hours has lasted months. That is not accidental. In efficient markets, price differences disappear fast because capital hunts profit. The fact that this spread persists suggests that the buyers do not care about short-term arbitrage profits. They care about securing ounces. That is long-game strategy. Silver is essential for solar expansion, electrification, military systems, electronics, and next-generation technologies. It is both an industrial metal and a monetary hedge. In a world facing currency uncertainty, rising debt levels, and geopolitical fragmentation, physical silver becomes more than just a trade. It becomes insurance. And when insurance is cheap relative to perceived future risk, smart capital accumulates quietly. The West may still believe the future's price represents true value, but sustained premiums in physical markets challenge that belief. If physical exchanges demanding real delivery become the dominant reference point, price discovery shifts. When that shift happens, it happens fast. Speculative leverage unwinds, shorts rush to cover, liquidity thins, and suddenly the price everyone thought was stable adjusts to reflect actual supply and demand. We are not there yet, but the signals are building. Deliveries, premiums, export controls, domestic retention, forward tightness, sovereign accumulation patterns, dollar diversification, commodity alliances. These are not random data points. They are structural indicators. The question is not whether silver will move tomorrow. The question is whether we are witnessing the early phase of a multi-year revaluation. If you understand the importance of physical flows over paper noise, if you focus on deliveries instead of headlines, if you watch where the metal is actually going, you are already ahead of most participants in this market. This is exactly why we analyze structure, not speculation, here at Gold Silver Scope. If you found this breakdown valuable, make sure you subscribe to Gold Silver Scope, stay connected, and follow for deeper insights into gold and silver markets. We focus on what truly matters: physical demand, macro strategy, and long-term positioning. And remember, this content is for informational and educational purposes only. It is not financial advice. Always do your own research and consult with a qualified financial professional before making investment decisions. The real story in silver is not on the surface.